go back to Jen Rogers in Omaha, Nebraska, who's joined by Michael Sonnenfeld, founder, president of Tiger 21. Jen, how's it going?
Thanks so much, Sazi. Yep, we are still here. Shareholder shopping day underway. Michael Sonnenfeld just flying in. You guys have 750 ultra high net worth clients, about $72 billion in assets. Berkshire is widely held. So is Amazon widely held. What do you make of the news that Berkshire, after so long, has finally dipped a toe into Amazon?
First of all, I think they just have a toehold in Amazon. Apple is a much bigger holding, and Apple has always been one of our top holdings, so there's a lot of confluence. But outside of the tech area, Berkshire is our number one stock holding. So we have a delegation here of 20 plus members who are major shareholders in their own right, and it's great to be here.
Do you think that Berkshire is changing at all, and what do your clients think of that? You know, in terms of not buying companies outright, we can look at the Kraft Heinz 3G deal, or you can look at something like the Amazon news.
So first of all, we don't have clients, we just have members.
Members.
But I was in a portfolio defense. Members talk about their portfolio with each other. And the young member, this was a young member, said, if there's a downturn, I'm not going to sell my tech stocks because people are still going to buy online. They're still going to talk online. They're still going to communicate. So he was getting rid of the more conservative stocks because he thinks the better bet in a bad time are the tech stocks that are going to go. So it's a turning upside down. So I suspect Berkshire adding Amazon is putting its toe in that premise that in good times and bad, Amazon's still going to be the place that you can get a shopping center on a desk.
That's actually a really good question. I mean, do you see, we're in a particular juncture where we're seeing a lot of technology IPOs coming to the market, the unicorn phenomenon, as you were. Next week, we're expecting Uber after, that's one of the most hotly anticipated IPOs of all time. I mean, what do you think of that particular sector or that segment of the market? And then do you see in a year at some point where Berkshire could actually buy stock in Uber or Lyft? What do you think of that? That's a really weird concept.
I won't predict that, but within our members are some of the great entrepreneurs in America who have sold their business. We're now in 5 countries. So our members have made their money in private equity. So what you're seeing is when Uber and these other companies are going public, that's where all the private equity investors are getting a chance to liquefy their investment. That's what our members are doing. They've been in these stocks before they're going public, and this is a great opportunity for that. But, people compare this to the prior IPO craze 20 years ago with the tech stocks. The thing that's different is because of all the regulation, the companies that are going public today are much bigger companies. They're real companies. They have real momentum. So I'm not going to predict whether the stock will go up or down. Obviously, we saw with Lyft it had didn't have some lift. But these are companies that are really, really momentum building with multi-billion-dollar franchises. So that's the big difference between a generation ago.
Well, let me ask you this. I think that one of the hallmarks of the unicorns at this point is, with the exception of maybe 1 or 2, none of them are profitable yet. So you're asking investors to take a vote of confidence in a company that legitimately is not making money. So it used to be that when you were a company that wanted to go public, you were profitable, you had a value proposition, a lot of it is very speculative, but in these guys' case, these guys are running losses of $1 billion plus. So how do you as an investor approach the unicorns and say, okay, this is a bet worth having, and when you're a unicorn and you have to come to the market 3 or 4 times a year and say, we're still not making any money, how much patience must investors have with something like that?
So most of our members are what I would call meat and potatoes builders. They were basic businesses, just like you're talking about, profitable, cash-flowing businesses. So they're more comfortable in the private equity area where they're building company and taking them public, as opposed to speculating in the new startups. But we have a subset who have been amazingly successful tech investors, and they know how to separate the wheat from the chaff. We have members in 54 groups, 30 cities across the globe, 30 markets across the globe. So if you go to Seattle, our members in Seattle know just what you're talking about. They can figure out which ones have a better chance. But by and large, private investors use the public markets to exit. And that's where they got the most extraordinary returns. That's how our members have been playing it.
All right, Michael Sonnenfeld, Tiger 21, your first time here at Berkshire, but you're leading a delegation of some 20-plus members. Have a great meeting. Thanks so much for coming by.
Thank you.
And we're going to throw it right now back to New York.
All right, that's Jen Rogers, Javier David, and Tiger 21 founder Michael Sonnenfeld. Thanks, guys.